This is the final step in the accounting cycle. That is, what we must do now is close the books. We have completed the accounting records up to June 30th, and we have prepared the income statement, revenue, and all these expenses. Now, at the beginning of the accounting period, revenue was 0. At the end of the accounting period, it's $104,000. Same with all the expenses. They were 0. And these balances represent the transactions that have taken place just during the month of June. Now we're starting into July. What we must do is adjust our records. Our ledger still has a revenue account with a credit balance of 104 and all these expense accounts and a dividend account. It also has the retained earnings, but at the beginning of June, the retained earnings have not been increased by the net income or reduced by the dividends. That is now the purpose of these closing entries. The first closing entry then, June 30th, I want to close the revenue account. It has a credit balance, so I debit it, $104,000, and I create a new account called Income Summary. This is a T account which I'm going to summarize the closing entries, and because I debited revenue, I credit Income Summary 104. And all the expense accounts in my records have debit balances, so to bring them to 0, I credit each one. Salary expense $32,000, utility expense $1,200, and so on, and debit Income Summary $42,200. Now to close Income Summary, as you can see, has a credit balance of $104,000 and a debit balance of $42,002. So to bring Income Summary to 0, I must debit it $61,800, which is my net income, and increase retained earnings by the same amount, $61,800. So that adjusts my retained earnings up by the net income. There's one more thing, and that is I have to close the dividends account to retained earnings. In my records, dividends has a credit balance. Therefore, to close it, in my records, dividends have a debit balance, so to close it, I must credit it. And I reduce retained earnings by $10,000. So now these are the closing entries. What I do now is I post them to the ledger, and when I do that, I bring revenue to 0, all the expenses to 0, and I adjust the retained earnings up by $51,800, which is indicated in my statement of retained earnings. And then I prepare what's called a post-closing trial balance. Now at the end of June 30th, recall this is what my ledger looks like. I still have revenue of $104,000 here. I have all the expenses with debit balances. I have the account called Income Summary. The retained earnings is the retained earnings at the beginning of the accounting period, which was June 1st. So the effect of closing the books then, by posting my closing entry, this is what will happen. To begin with, I debit service revenue 104 and I credit Income Summary 104. So now service revenue has 104 on the debit side and 104 on the credit side. So effectively it has a 0 balance. Now I do the same with all the expenses. I record a credit to each one of the expense accounts. Credit salaries expense $32,000. Credit insurance expense $200, miscellaneous $600, depreciation, rent, supplies, as you can see, and I debit then Income Summary $42,200. So now you see service revenue has a 0 balance, and all of these expense accounts have 0 balances. Okay, debit $600, credit $600, 0 balance. Debit $6,000, credit $6,000, 0 balance. So I bring them all back to 0 at the end of this accounting period. So they begin the new accounting period with 0 balances. The next step then is to close Income Summary, to retained earnings. And you can see that I need a further debit here of $61,800. And so by doing that, I close out income summary, 0. And that $61,800, recall, is my net income. And I basically increase my retained earnings by $61,800. One more thing, and that is the dividends down here. They still sitting here with a $10,000 debit balance. I must credit them and debit retained earnings. Now my retained earnings has a credit balance of $202,600, which we have on the balance sheet. So now you can see that all we have left are balance sheet accounts: cash, accounts receivable, supplies on hand, prepaid insurance, trucks, and buildings. Accounts payable, common stock, salaries payable, and retained earnings. Accumulated depreciation buildings, accumulated depreciation trucks. So now we can do what's called a post-closing trial balance. So now at the end of June and the beginning of July, the only accounts in my records that have balances are balance sheet accounts: cash, accounts receivable, supplies on hand, buildings, accumulated depreciation, trucks, accumulated depreciation, accounts payable, salaries payable, common stock. And notice the retained earnings has been adjusted up. So we begin July 1st with retained earnings of $202,600, and any revenue then will increase retained earnings. Any expenses paid in July will decrease it, and any dividends will decrease it. And we'll keep a record on each one of those types of transactions and then adjust the retained earnings at the end of the next accounting period. So we have a post-closing trial balance, debits of $605,800 and credits of $6,500. $6,005,800, and that completes the accounting cycle for the whole month of June. That is, we started off with balance sheet accounts, which are permanent accounts. Any transactions that increased retained earnings were revenue transactions, and we recorded those. And any expenses transactions which decreased retained earnings, we set up separate accounts for them, as well as the dividends. Then we analyze all of that, we adjust the records, we prepare the financial statements. Then when we completed that, we close the books and fold, if you will, the revenue and expense accounts into retained earnings and the dividends into retained earnings. And that's the complete accounting cycle.